Welcome to this lesson on pump and dump schemes, one of the most dangerous forms of market manipulation in the cryptocurrency world. In this video, we'll explore how these coordinated scams work, who profits from them, and most importantly, how you can protect yourself from becoming a victim. This is part of our crypto security series, designed to help you navigate the crypto space safely. A pump and dump is a coordinated scheme where groups of people work together to artificially inflate the price of a cryptocurrency through false hype and misleading information. Once the price reaches a peak, the organizers sell their holdings for massive profits, leaving everyone else with worthless tokens. The scheme has three key characteristics: artificial price inflation driven by fake excitement, massive profits for the organizers who planned it all, and devastating losses for regular participants who bought in late. Every pump and dump scheme follows four distinct phases. Phase 1 is pre-launch, where organizers secretly accumulate large amounts of the target token at very low prices before anyone knows what's coming. Phase 2 is launch, when a coordinated signal is sent to group members revealing which coin to buy and which exchange to use. Phase 3 is the pump, where mass coordinated buying creates artificial demand and causes a rapid price spike that attracts outside investors. Finally, Phase 4 is the dump, where organizers sell all their holdings at peak prices, causing the value to crash and leaving victims holding worthless tokens with significant losses. These schemes are typically coordinated through messaging platforms, with Telegram and Discord being the most common choices. Organizers create private channels that can contain thousands or even tens of thousands of members. When it's time to execute the scheme, all members receive simultaneous buy signals telling them exactly which coin to purchase and when. This coordinated action creates the artificial demand needed to spike the price. Not all participants in these schemes are equal. There's a clear hierarchy with two distinct groups. The inner circle consists of the organizers and their closest associates. These are the people who benefit from pre-pump accumulation, meaning they buy the tokens before the scheme begins. They also have early exit advantage, selling their holdings before the price crashes, which guarantees them profits. The outer circle, on the other hand, consists of regular group members and outside investors. These people enter late at peak prices, unknowingly provide exit liquidity for the inner circle to sell into, and ultimately absorb all the losses when the price collapses. There are several red flags that can help you identify a potential pump and dump scheme. First, watch for sudden extreme price spikes that have no fundamental reason or real-world explanation. Second, be cautious of aggressive social media promotion that uses fear of missing out tactics to pressure you into buying quickly. Third, be wary of unknown tokens with low liquidity and small market capitalization, as these are easier to manipulate. Finally, any promise of guaranteed returns in a short time frame is a major warning sign, as legitimate investments never come with such guarantees. Researchers and exchanges use several methods to detect pump and dump schemes. Volume analysis involves monitoring abnormal trading volume spikes that occur without any legitimate news or developments. Social monitoring tracks coordinated messaging patterns across multiple platforms like Telegram, Discord, and Twitter to identify organized manipulation campaigns. Machine learning and artificial intelligence models are also increasingly being used to detect suspicious price patterns and trading behaviors that indicate potential pump and dump activity. The impact of pump and dump schemes on victims is devastating. Statistics show that over 95% of participants lose money in these schemes. The average loss is approximately 70% of the initial investment, meaning most people lose the majority of what they put in. Perhaps most shocking is the speed of the collapse. The time from peak price to crash is typically less than 5 minutes. This means most participants buy near the peak and have no time to sell before the value plummets, leaving them stuck with nearly worthless tokens. Protecting yourself from pump and dump schemes requires discipline and careful research. First, Always research token fundamentals and investigate the development team behind any project before investing. Second, completely avoid pump group invitations and channels, no matter how tempting the promises may be. Third, check liquidity depth and trading volume history to ensure the token has genuine market activity, not artificial manipulation. Finally, stick to established projects with real utility and proven track records, rather than chasing quick profits in unknown tokens. Let's review the key points from this lesson. First, pump and dumps are coordinated manipulation schemes designed to exploit unsuspecting investors. Second, only the organizers profit from these schemes, while regular participants lose heavily and often lose most or all of their investment. Third, warning signs include sudden price spikes, aggressive promotion, unknown tokens, and promises of guaranteed returns. Fourth and finally, you can protect yourself through thorough research, avoiding pump groups entirely, checking token fundamentals, and sticking to established projects with real value. Remember, if an investment opportunity sounds too good to be true, it almost certainly is.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.